Welcome to this great webinar. Big topic, big numbers. It's all about pensions. It's all about getting your pension money working better and all the options. And we've got two brilliant experts to do that, who I'll introduce shortly. There is £2.4 trillion in private pensions. That's bigger than UK GDP. So it's obviously important to get it working very effectively. And actually, I think, and this is total assertion, right? I think that we underestimate the power of the pensions. I think we underestimate what we can do with our pension capital, and underestimate the importance of actually putting it to good work. A lot of it is quite passive. And we're all good, creative, entrepreneurial types. So let's find out what we can do with two brilliant experts. So I'm Mike Bristow. I'm your host for today. I'm CEO and co-founder of CrowdProperty, and we'll be joined by, very excitingly, both George Ttouli from Burlington Wealth Management, who'll be discussing a lot of the differences between defined benefit schemes and SIPP schemes. And then we will be handing over to John Moore from Leadenhall Wealth Management, who will be talking about Sas. All of these are exciting, we can do exciting things with. Some of this will be quite technical. Let's make it two-way and discursive, and let's make sure we've got plenty of time at the end to really sort of crack through sort of, what your burning questions and ask the experts. That's what we're going to try and do at this great Qandor Tropolis webinar. So a bit of housekeeping first. So we'll be, the team behind the scenes will be posting on LinkedIn for just a bit about this session. So do pop to LinkedIn. I think they're going to add in the details into the chat, just to show you the link for that LinkedIn post. If you like that, that's great. And also, you know who else is on this, and also you can start the discussion, continue the discussion on that afterwards. So do I need, I'm just wondering if we got the right slides up. If we can just pull this up, that's great. So yes, just the sort of housekeeping bits. Any questions for the panel during the webinar, please just pop them in the Q&A function. You can see where that is at the bottom of your screen. The team will be looking through that, and will either, if it's a quick answer, someone might just get back to you on text through that panel. Otherwise, we'll put it to the experts verbally, keep them flowing through the session. If they're relevant to bring up right there and then, we'll throw them out there, and I'll interrupt the brilliant speakers and make it two-way. Otherwise, we'll pick them up at the end of the session, and also we can continue the conversation on LinkedIn afterwards. So I think that's about it. So I'm going to introduce the brilliant George Ttouli to run us through a few slides on defined benefits and SIPPs pensions. Over to you, George.
Hi, I hope you're enjoying the free content. My name is Matt Siddell. I started Qandor in 2017. In 2020, we launched a property academy called Tropolis. If you want to know how you can come and join our fantastic network and work with the wonderful people that we help and support, then click the link below and book your call with me today.
Thank you very much, Mike. Thanks very much for a super introduction. Just a couple of quickies. My name is spelt with two T's. For those of you that don't know me, that is the correct spelling you can see on the side there, double T-O-U-L-I. Luckily, it is easy to say. It is just Ttouli. And that picture of me, you might think that doesn't correspond with the person you can see now talking to you, but that really is me, I can assure you. That's what I look like in normal times. This is my lockdown look, if you like. Couple of quickies. Burlington Wealth Management is part of the St James's Place group. Just wanted to mention that we are part of this large national company. It's a FTSE 100 company for those of you that don't know about them. And they sit behind the scenes and support us in the advice that we give. Okay, we're talking about pensions today. And as most of you know, many different types of pensions exist out there. In fact, I've often joked that pensions has its own language. You've got personal pensions, SIPPs, you've got company pensions, final salary, defined benefits. It goes on and on and on. Today, we're going to talk primarily about three types of scheme. We've got to talk about final salary defined benefit schemes in a moment. I'm going to talk about SIPPs and give you some really good examples as to how you can use SIPPs to purchase commercial property. And then I'm going to hand over to John, who's going to talk about the SAS, the small self-administered scheme. Okay, next slide, please. Okay, so defined benefit transfers. Let me just explain what these are for those that are not familiar with them. This is the old final salary pension. Okay, this is considered to be the Rolls Royce of a pension scheme, and you don't see many of these out there anymore. People that have got these usually were employed for some point for a large blue chip company. And what happens with these schemes is that the benefits, the pension accumulates automatically. It's not linked to investment performance. And when somebody retires and draws income from these pensions, they can get a guaranteed income every year. The income goes up every year, usually in line with inflation. And in this whole process, there's no risk. And I think that's why a lot of people like having this type of pension. Okay, but what's happened is since 2015, George Osborne, the Chancellor at the time, introduced another option and said, look, if you want, you can get away from these schemes. You can actually request your trustee to give you a transfer value, okay? And it's incredible. We've seen some very big transfer values here, and you need to look at, if you've got one of these or know someone who's got one, they need to look at this option to find out what is the transfer value. As you can see from the slide, they can be quite generous, and it means if you think you can do better with that money, rather than be given a regular monthly income, then it might be worth considering a transfer. But apart from that, other reasons why a transfer might be considered is you've got improved flexibility. You could have a situation where somebody has got poor health. In that case, having a guaranteed income without a cash lump sum might not work if it's only going to be for a shorter time. These schemes tend to have benefits for partners and for dependents. If somebody's single, why have those benefits? Why not look at getting possibly the transfer value? And some of these schemes are insolvent, believe it or not. There might be problems with the guarantees being honoured. So, you know, there's certainly scope to have a look at what the values are of these pensions if anybody's got an old final salary or defined benefit pension. Okay, moving on to the next slide, please. Thanks. So it's a big decision. You know, if you were to move out of a defined benefit scheme, there's no turning back. I mean, I don't think that a trustee out there will say, right, okay, don't worry, you've changed your mind, come back to us and we'll sort you out. So obviously advice is essential, but there are risks, and you've got to start off on the basis that you're giving up guaranteed income for the rest of your life, okay? And before a decision is made to move away from it, you've got to look at these 5 key areas, basically. Longevity, what we mean by that is, will the money be invested correctly in order to provide you income for the rest of your life? Because you're moving from no risk to investment risk, taking control of your own money. We've got to think about inflation. I've touched earlier that these schemes have regular annual increases. This is done by legislation. So if you're basically taking over the pot yourself, you've got to think, can you generate the same income in the future and have that income increasing every year? You've got to look at interest rates, and most importantly, you've got to have the capacity for loss. What if it all goes wrong? What if your investments don't work out? What will be the effect on you if you get it wrong? It's better as well if you've got some investment experience, we would normally say. That could help justify a transfer. So all we're saying about this today is this is a big area. Both speakers, John and I, are qualified to give any advice on defined benefit transfers. So just keep that in mind. Okay, let's move on to the next slide, which talks about the tax efficiency of pensions. As Mike said, there's a lot of money in pensions. And one of the reasons for that is that the government gives some very good tax benefits to keep money in pensions. But there are four main tax benefits. I'll just whiz through them quickly. First of all, when somebody adds money to a pension scheme, they get tax relief. Okay, so really important for high rate taxpayers. You can actually reduce your tax bill by diverting money into a pension scheme. Once the money's in a pension scheme, it's very tax efficient. There is no capital gains tax, okay? And you'll see in my example in a moment about how you can invest in commercial property and not worry about capital gains tax on selling the property. Okay, there's no income tax on investments held within a pension. Again, for people that own commercial property in their pensions, that means the rent they receive is free from income tax, which is fantastic. And finally, if somebody dies, the value of their pension does not form part of their estate. So it doesn't get taxed under inheritance tax, which some of you know is 40%. So these are the four key reasons why any good advisor will always talk about pensions to their clients. Okay, let's move on to the next slide, which is all about SIPPs, the self-invested personal pensions. So I know I'm talking to a group of property people, and we indeed have a lot of clients who work in property, either as developers, even could be just landlords. And so we understand the attraction of property. Basically, a self-invested pension plan is a plan where you can choose what to invest in, okay? So a lot of people, when we meet them, have got money built up in pensions. They're sitting in the insurance company's funds. And some people actually find that quite frustrating. I remember one person saying to me, if I could access that money, I could invest it in property with my knowledge and make a far greater return than what they're doing. And I said, well, you can, okay? As you can see from the slide, you can only invest in commercial property. Unfortunately, residential is not classed as a qualifying investment in pensions. But if you can take your whole of your pension fund and invest it in commercial property and think you can do better, then go for it. It can be done through a SIPP, a self-invested plan. Okay, SIPPs can also borrow. If we can move on to the next slide. Thanks very much. A SIPP can borrow to invest. Now, there's a little bit of confusion over borrowing in pensions. I'm talking just about the SIPP as an entity borrowing to be able to enhance the value of its investments. Okay, that's a little bit different to loan backs in Sasses, which John's going to cover later. Okay, well, let me give you a great example. This is a real example. A client of ours, Mr. A. Obviously, that's not his real name, but Mr. A sourced a commercial property. Okay, property purchase price £550,000. Now his pension fund value at the time was only £400,000, and we said, look, no problem. We can actually get a loan. It's just a mortgage, effectively, where the property you're going to buy will act as a security, and the pension scheme rules allow us to lend the client up to half the value of his pension. Okay, so not to be confused with half the value of the purchase price, but if the pension fund's worth 400, in this example, we could secure a loan of up to 200. We only needed 150 to add it to the 400, and he was able to then go on and buy the property. Okay, can we move on to the next slide, please? And keeping with the same client, Mr. A, these are the tax benefits of buying this property. So he bought the property for 550, as I just mentioned. He didn't plan to occupy it himself initially. He was planning to rent it on the open market. The rent would have gone into the SIPP, into his pension plan, rent-free, tax-free, I beg your pardon. As it transpired, he couldn't get a tenant for 6 months. So he thought, okay, look, tell you what, I'll move my business into this unit and we'll work from there. So he gave up paying rent to a third party, and his business started to pay rent to his own pension. Yeah, his own pension was receiving rent from his business, and that's accumulating tax-free, and that'll go on for as long as he's there for. Okay, now the business still gets corporation tax relief. The company obviously has to pay rent for its premises, and that rent is a business expense, quite rightly, and that reduces the company's corporation tax. And most importantly, like I touched on earlier, no CGT when he decides to sell this unit. And this example actually is nearly 4 years old. And I can tell you now that this property is worth about 750. So if he decided to sell it next week, £750,000, the £200,000 profit is made by the pension, no capital gains tax. So it's a brilliant benefit, often overlooked. Okay, let's move on to another example, actually. That's on the next slide. And some people have said to me, look, you know, it all sounds great, George, but my pension's not worth a lot. What can I buy, you know, with just the value of my pension? And I say, look, you can actually combine resources. And we've often done this for families. We've had situations where colleagues have all got together and bought a property. And I'll give you again a real example. This is Mr. and Mrs. D, who bought a commercial office, actually. And the property was worth, well, the purchase price was 1.8 million when it was purchased a couple of years ago. Now, what happened was Mr. and Mrs. Basically had a pension each. The values of their pensions were 600,000 and 300,000, okay? And I told them, look, you can borrow money as well against your pension value. So remember, there's a limit, 50%. So the most that Mr. D could bring to the party was 900. That's his pension of 600 plus a 300,000 loan. And the most Mrs. D could invest was 450, which is her 300,000 plus a loan of 150. Okay. So I said to them, you know, go out there, go and find a commercial property, 1.2, 1.3, and we'll get it sorted for you. Okay. I got a call a few months later saying, George, found this fantastic property. It's absolute gem. We want to buy it. I said, what's it worth? 1.8. I said, oh gosh, only 500,000 over the limit that I gave you. But don't worry, let's work this out. So what we did, we used all the pension money. Obviously, that's the two figures you can see on the column on the left, 600 and 300. We were able to borrow a further 300 and 150. So we got their personal contributions up to 900 and 450. And we set up an SPV, a special purpose vehicle. This consisted of both of them being shareholders with a friend of theirs. They all put some private capital into this to generate another 450. And that's how the property was purchased. So this super office block in North London, they bought the freehold for 1.8 million. And it's owned like this. Half of the freehold is owned by Mr. D's pension. A quarter is owned by Mrs. D's pension, and 25% is owned by the limited company, the SPV that they created with their friend. So it's a brilliant example of how you can use part of your pension money to buy a stake in a commercial property. It doesn't have to be the property purchased outright. Okay, let's move on to, I think, my last slide, then I'll let John have a go. I just want to talk about the use of trusts and inheritance tax. Like I touched on earlier, one of the best tax benefits for me of having your wealth held in pensions is that on death, it doesn't form part of your estate, and therefore it doesn't get taxed under inheritance tax. Okay. Now, pensions are run as trusts effectively. It's all based on trust law. And that's why sometimes you see this reference to trustees. You know, people say, "What? Hang on, who is the pension trustee? What's that all about?" But the trustee is usually the administrator of your pension plan. And if somebody dies, believe it or not, the trustees decide who gets paid what and when, which is amazing. So a lot of people who've got pensions, often referred to as the member, by the way, the member will fill a form called an expression of wishes form or a death benefit nomination form. And what they're doing, they're instructing the trustee what they want to happen in the event they pass away. But we say no, go one step further. What we do is we have a trust arrangement, which we recommend, where you set up a simple discretionary trust and you appoint your own trustees. So your instructions to the trustees are, look, don't worry about it. If I die, I want you to appoint my own trustees, which will usually be a spouse or adult children, and they will decide who gets what. So the spouse and adult children can basically be trustees and beneficiaries of the pot, obviously. And whilst this is going on, this pot goes from a pension into a trust. It remains outside the estate of the deceased. It remains outside the estate of the spouse and of the adult children. And it just passes through the generations free of inheritance tax. It's a super arrangement and something which people need to seriously consider. So I think that's pretty much me done. The next slide just summarizes really that I think financial advice is essential with pensions. A lot of decisions can't be reversed. You need to find an experienced, highly qualified advisor. If they've got any of those qualifications, that'll be really important. Obviously, a regulated advisor is essential. You have recourse in that case. That's the logo on the left, the FCA. But just to finish up with, I'd say keep an eye out and use pensions to invest tax efficiently. Especially if you have an interest in commercial property, you can use that money for that purpose and use trusts to avoid inheritance tax. Okay, and I think that's me done. My details are there. Please scribble them down if you want to. But I'll hand over to Mike.
Brilliant. Thank you, George. That was a brilliant Chris Whitty, next slide please, impression. Very, very good. And there is nothing wrong with the lockdown hair. Just to sort of pick up a couple of points, I'm going to reiterate the number I said earlier, 2.4 trillion pounds in pension funds in the UK. And all I heard, the big takeaway from George there was tax efficiency, which is imagine that on a global scale versus that 2.4 trillion, that's worth so much. Okay, so much. There's so much value in there. I should have said also, and just to reiterate George's point there, the importance of regulated chartered advisors here. Both George and John are both that. Now, if you'll bear with me 1 second, George, I'm going to fire you 2 quick fire questions. Right, so we've got some interest just to cover off a couple of the SIP ones, and then we'll come on to you, John. So firstly, Jeremy, thanks, Jeremy, says, if one had a government final salary scheme, can that be transferred, e.g. civil service or HM forces?
Yeah, thank you very much. That's a brilliant question, actually. The answer is it depends on the scheme. Some of the public sector schemes have got a transfer value. They have got a big pot of money behind the scenes that is funding the pension. Unfortunately, some don't. What I mean by that is that there isn't a big pot of money. All that's happening is that the shortfalls are being funded by the taxpayer, would you believe? So on the schemes that are not funded, there is no option to do a transfer out. Unfortunately, it's only for the schemes that are funded. All private sector final salary schemes are privately funded by the employer, and there are some public sectors that are funded. Yeah, but if Jeremy wants to sort of contact us and give us his personal details, we'll look into it for him.
Brilliant. That's excellent. It's a great question. Thank you. Now, what I'm going to do, I'm going to pause on the other questions because I think a number of the questions will have similar and some different answers between SIPs and Sasses. And I think that's important to understand as well. Now, all of that 2.4 trillion pounds cannot entirely be placed towards lending on CrowdProperty. So why don't we now hear from John Moore of Leadenhall Wealth Management, a new Qandor affiliate as well. And John's going to tackle the big SAS question, and then we'll have a big Q&A session afterwards. Over to you, John. Thank you.
Thanks very much, Mike, and thank you again, George. Hello, everyone. Just a very brief note about myself. I'm a director at Leadenhall Wealth Management, and I'm also a pension transfer specialist like George. So that means I can advise on defined benefit schemes and defined contribution schemes such as Sasses. I've actually been working with Sasses for about 15 years now. But before we start, I just wanted to raise a quick point that if you are discussing Sasses with anyone, it's important, I mean, George touched upon this as well, it's important that you speak to regulated firms, especially when it comes to the transfer of pensions, because as financial advisors, we'll talk about the benefits of Sasses, but we also need to talk about the risks as well. But most importantly, if we're wrong about the advice, you can go to the Ombudsman. Whereas if you're dealing with a non-regulated firm, you've got no recourse and therefore no protection. So I thought that was quite important to talk about. So in this presentation, I'm going to show you the main differences between SIPPs and SSAS and how Sasses can potentially help with residential property projects, not just commercial ones. So that's quite interesting, I would say. So the first slide shows how borrowing can help with the purchase of commercial property. It should be noted that borrowing can be achieved with both Sasses and SIPPs, as George mentioned in his slides. Slide 2 is we're going to talk about loan backs, which can help with the purchase of residential property, not just commercial units. The main difference between Sasses and SIPPs are that Sasses can provide loan backs, whereas SIPPs aren't able to. And then briefly, the advantages and disadvantages of Sasses on slide 3. Right, so slide 1, we have 3 directors of a limited company, and they want to purchase a £2.25 million commercial premises. So they set up a SAS, which is a small self-administered scheme. So a SAS is a pension trust, and the only way that you can set up a SAS is if you have a limited company in the first place. So the limited company would be the sponsoring employer of the SAS. Now you can have up to 11 people in a SAS. So in this scenario, 3 people is absolutely fine. I would say 11 people is a bit cumbersome to bring into a SAS because the SAS is a pension trust, and therefore if you get 11 people in there, you've got 11 different decision makers. So potentially 3, 4 or 5 people maximum, I would say, and you should have in a SAS for that reason. And one of the other rules is like the SIPP, you can have 50% of borrowing. So I'm just going to illustrate it here. Right, so each of the directors has a pension each. Conveniently, they have £500,000 each. So one has a personal pension, one has a final salary scheme, and one has a SIPP. These pensions are transferred into the SAS, which now makes it worth 1.5 million. And because of the 50% borrowing rule, the SAS can borrow another 50% on top of the 1.5. So in this scenario, the SAS can borrow £750,000, which then means that they can go off and buy commercial property for 2.25 million. So exactly the same as George has said in his last slides. So examples of premises that the SAS can buy are offices, pubs, care homes, dental surgeries, coffee shops. Now they just need to be commercial. Any questions at all on the slide before I move on to a live case?
John, I'm going to ask you one question that's come up. So you mentioned limited company. What if someone doesn't have a limited company at the moment? Can they set up almost a pseudo shell one, or an intention to trade one? So for example, if someone had a business plan to look for land to purchase, can they allocate a SAS into that?
The tricky part with that is that the company needs to be trading, and it needs to show proof of trading. And that's what HMRC they're very hot on. You know, they're very aware of people just setting up companies just to access their pension scheme. So you sort of have to be careful there. It does need to be a trading company, and they have to show proof that it will be a trading company. So that's not to say that people don't go off and set up limited companies and start, income and trading, and therefore they're legitimately allowed to set up a SAS, but it does make it more difficult. So yes and no to that answer. Right, next slide. So this is a live case that I've got at the moment. So I've just got my Zoom bits here. It's a so I've a client who's a franchisee of a soft play business in Bristol. She's purchasing a commercial unit of £600,000, and she requires 300k of capital to install a cafe and cover the purchase and development costs of the build. Now, she has a £650,000 SIPP with Hargreaves Lansdown, and I advise her to transfer the SIPP to a SAS, as she wants to make use of loan backs in the future as well. So again, a SIPP can legitimately do this as well, but the reason we set up a SAS instead is because in the future she's thinking about using loan backs as well. So the SAS is going to raise a further 325k on top via borrowing, on top of the 650k, and she can achieve her objectives. And just to sort of labour that point, SIPPs and SSAS can provide both borrowing. Now, moving on to loan backs, we have a limited company with 3 owners. So I'm just going to minimise that. And their objectives are they need business funding into the company because they want to develop residential property. So they set up a SAS, and same rules as previously, but this time the 50% loan back rule will be illustrated here. The maximum term for any loan back is 5 years. So if you're using the SAS for a loan back and you want to purchase property, for example, it's not really a buy and hold situation. It's more of a buy, develop, sell situation. Otherwise, you know, a five-year term means the loan repayments are fairly substantial. Again, they've got 3 pensions. We advise to transfer into the SAS. The SAS value is 1.5 million, but now using the loan back rule of 50%, £750,000 can be loaned to the business to develop their property. Now, because it's a loan, they have to repay the loan. So the first payment of £178,200 is paid yearly, and that's over a period of 5 years. But the first, fairly important, the first repayment isn't due until the end of the first year. So you could put money, the £750,000 into Breezy Development, you can develop the houses and hopefully potentially sell them in time, and then you can pay back off the loan in one go, or straight away even. Now, after 5 years, the £750,000 of capital is repaid, but interest of £141,000 is paid to the SAS. Now, because the directors are borrowing from themselves, that interest is paid back to their own pension schemes. If you went to a HSBC or a Lloyd's, you'd be paying them the interest instead of your own pension. So that's quite an important point, and something that directors in this situation really like. So examples of businesses that can utilise this, it has to be, we touched upon this, it has to be a trading company, but these companies can be property development firms that develop residential property. So quite apt for this group, I think. Mike, any questions here at this stage?
No, keep going. All good. Thank you very much.
So a live case at the moment, I have a client who's purchasing a property in Brighton. He had a defined benefit scheme valued at 450k in 2020. And to his surprise, and actually to my surprise as well, in 2021, that increased to £950,000. So he sort of, said, John, look, we've got to get this transferred. And, after doing a report and looking at this, we agreed with him. We would transfer it. But that's fairly unheard of, that sort of size increase. But it just goes to show you that these sort of big pensions, it was Shell in this case, they actually want to get you out of defined benefit schemes because it costs them a lot to run those schemes. So that's probably why you're seeing one of many reasons why you're seeing high transfer values, and also 10-year gilt yields of been pretty low as well. So my client wants to purchase a 2-floor commercial unit where he's going to convert the top floor to a residential flat. And after developing it, he believes he will increase the property value from 350k to £1 million. We advise him to transfer the DB scheme to a SAS, where his limited company will receive a loan back of £475,000. 375k is going towards this project, and he's going to use 100k towards another residential project. And so to labour this point, only Sasses can provide loan back. So that's the main difference between SIPPs and SSAS. And just to make a point that George and I can advise both on SIPPs and both on SSAS. So it all depends on the position of the person and their objectives. Now this slide, if you just want to take a screen grab of this, I won't go through every single point, but this is the advantages and the disadvantages of SSAS. And I think Matt's also going to pass on the recordings of this as well. So yeah, any questions at all at this stage?
There are a load of questions coming in, however, why don't you wrap up your slides and then we'll dig into them. I'll fire them out. Okay.
Well, I mean, if people just want to take a screenshot of this. I mean, so I tend to use Sasses as a financial toolkit for my clients who are most of the time limited company owners. So everyone knows with small businesses you can have good years and bad years. So in the years where the business has been really successful, make company contributions into the SAS where you save corporation tax. So for example, if you make £100,000 pension contribution into a SAS, you save £19,000 in corporation tax. But in the more challenging years, you've built up the SAS over time, you can borrow back out of it using the loan back facility. So 9 times out of 10, if you're a limited company, a SAS is quite useful for helping with the finances of the business. I won't go through all of these points as well because I'm sure people have got more questions. If that's the case, Mike, or shall I keep going?
Keep going.
Okay.
This brilliant stuff, and I'll fire the questions out shortly.
No problems. Right. So in terms of corporation tax and putting money into a pension, a SAS or a SIPP is a good way of extracting profits out of a business. So you've got salary, dividends, expenses, and pension contributions. The difference is if you're paying yourself a salary and dividends, you pay tax on those amounts. Whereas if you're making pension contributions, you're actually reducing the tax of the company. Yes, when you do come to take benefits from your SAS, you get tax-free cash and you pay tax on the income that you receive. But it's a good way, if you haven't utilised your pensions, it's a good thing to start doing if you've got a limited company, or even if you don't have a limited company. There are some SASs out there that allow contributions more than the annual allowance of 40,000. So you can have up to contributions of £160,000 per year. That's a particular type of SAS. Now, again, using the borrowing facility, you can take £1 million pension, and as George touched upon, you can increase the purchasing power of that amount of money. So £1 million SAS can buy a £1.5 million commercial property. The other point to mention as well is SASs and SIPPs can buy land as well as commercial property as well. So I don't know if that's interesting to people. Again, George mentioned SAS is a tax efficient place for benefits to grow, where it grows free of capital gains tax, tax on interest and dividends, tax on rent and inheritance tax. The SAS is interesting family structure because you can have up to 11 people in it. So it's a very good way of passing benefits down the generation. And, it works particularly well if children, want to take over the business in the future. Protection, because the SAS is a pension trust, it's creditor protected. So if you put assets such as commercial property in there, if anything happens to the business, then that asset is protected because it is a trust. You can also do fancy things like putting in intellectual property into a SAS, which protects it as well. exit planning. A SAS can provide a loan back to the business, and if the company's had enough distributable reserves over the years, then you can potentially help with the exit of the shareholder by doing a company buyback of shares, and obviously depends on the position of that person in the company. The other point to mention as an advantage is the running costs of a SAS are a deductible business expense, whereas with a SIPP, it's because it's an individual pension, it's not allowed to deduct those expenses. Now, disadvantages of a SAS, again, a trading limited company is required. This isn't required for a SIPP, so you can set SIPPs up without a limited company and do all the good things you can do with property within a SIPP. I would suggest the minimum SAS value that you look at has to be about 150,000, or all the annual costs start to eat up the value of the SAS. So you could combine husbands, wives, pensions, business partners, and anyone who has a vested interest in the company and the SAS. As long as that value's at least 150,000. And that's probably still a bit low, to be fair. Lending to a small business via loan back to a small company is high risk. There's no two ways about it. Day one, you do a loan back to a small business. Day two, it goes out of business. You've lost that money in the loan. I suppose the counter argument is if you're borrowing money from a bank, they will certainly want to claim their money back. So they'll probably, they might even take a personal guarantee. So the difference there, I suppose, is that to build up your pension, you've received tax relief over a period of time. So to receive £1 million pension, you've probably contributed about £600,000 of your own money, and the government has given you tax relief of £400,000. Now, to get to £1 million house, you've probably had to earn £1.6 million in salary to afford to buy a £1 million house. So there is a difference between the two in terms of risk, I would suggest. And just generally, Sasses are more expensive than SIPPs because they can do more things. So typically, they're about twice as expensive. I think I've waffled on there long enough, Mike.
Brilliant. That's brilliant stuff, John. Thank you so much.
Hi, I hope you're enjoying the free content. My name is Matt Siddell. I started Qandor in 2017. In 2020, we launched a property academy called Tropolis. If you want to know how you can come and join our fantastic network and work with the wonderful people that we help and support, then click the link below and book your call with me today.
Now, so hopefully we've brought some clarity to DB, SIPP, Sasses, some of the differences to contrast. But before we get into more detailed questions, I'm going to play, have I got news for you? Wheel of asset classes, right? And what I'm going to ask John is to say yes or no with regard to SAS, and George to say yes or no with regards to SIPP, because unsurprisingly, the creativity of the audience has thrown a load of different types of property at it. So let's start out. Firstly, land.
Yes.
Yes.
Good. What about land that you can then, your intention is then to apply for residential usage through planning?
No. It's if I could just elaborate a little bit. I mean, if you do buy the land and buy the property, once it becomes residential, it has to be sold. It can't stay in the SIPP.
John, is that the same for SAS?
For Sasses, it's slightly different. You can buy land and you can start to build residential property on it, but it has to be sold out of the SAS before people get to live in it. So you can actually buy the land, use the SAS to develop it up, but it has to be sold out at a fair market rate out of the SAS before people live in it.
Right, good. Longer than a yes or no. Many of these will be. Mixed use property.
No. If you bought a property that was, say, semi-commercial, a quick example, very quick example, We've done one with a shop at the bottom, retail, and a first floor flat. We had to separate the titles so that the individuals bought the flat with their own money, and then the SIPP, the pension, continued to own the shop downstairs. So no residential use at all.
John, same?
I'm going to qualify this. No. So you can't buy any residential with the SAS, but today I've just, a client of mine has just bought a commercial unit, which he is going to split the deeds of, and the second part, the top part, is going to become residential. So again, you can't have residential in there, but you can do clever things around it to buy the unit and get the residential out before people live in it. So no, technically.
Good. Resi to commercial?
No, not in the SIPP.
Commercial to resi?
No, these are two easy ones for me.
Yes.
John?
Yeah, buy the commercial, change it to resi, but you've got to get it out of the SAS before people live in it.
Okay, good. B&B or serviced accommodation?
That's a good one, because if it's classed as a commercial business, then yes. But B&B was always dodgy. It actually depends on the trustee. I'm afraid this sounds like I'm going to sit on the fence, but the trustees will say, okay, we've got to send the valuer surveyor around, and if it's just a house, with a few rooms in it, then no. If it's a proper purpose-built B&B, it might work. So it's a tricky one. There isn't a yes or a no answer, unfortunately, there, Mike.
Good, thank you. John, anything on that?
I have to agree with George there. I mean, you have to be careful when we're talking about people living in these places, and arguably hotels and Airbnbs is that, but there are some trustees that can sort of think of clever ways around that. So going to George's point, it depends on the trustees.
I'm definitely going to come back to trustees and investment control and decision making, because that's another question, but it's a big theme. I'm having a bicker with my SAS pension professional trustee at the moment about something. Co-living, stroke HMO, one, they're much the same, but and whether it makes a difference if they're sui generis or not.
Yeah, not in a SIPP. That's just not permitted. Yeah, it's just residential, isn't it? So it's not in a SIPP.
John, same.
You can't. The SAS can't own these things, but there's nothing wrong with them doing a loan back to their business to then invest into the HMO. The only issue again is that because of the 5-year rule, the loan repayments can be fairly chunky. So you can, but with an HMO, it's normally a buy and hold situation. So that makes it less possible, unless you're buying an HMO to then develop it and sell it. That's a different scenario.
Yeah, I think that's the big thing there. I mean, a big trend we see in the market for investors and developers is buy something, changing it into a HMO for your target market, keep it, yield it. So that doesn't really suit that pension structure. Great, thank you. I think an easy one, warehouse.
Yes.
There we go. That's a good one. I think this is going to be a straightforward one, but someone's asked crypto.
That's a really good question. I am not sure, actually. I'm actually not sure about that, because I've never been asked that one before. I know Bitcoin's massive at the moment. People are going mad on it, but no, I'm not going to guess. I'm not going to guess. I think it's fair to if that person wants a definite answer, just contact me and I'll check it out. Yeah.
John, anything to add on that?
I'm pretty sure Sasses can have crypto, and you can get platforms to do that. The only issue is you need to speak to the trustees, because, as you know, crypto can go up massively, and if you have to sort of be wary of that because of the lifetime allowance, which sits at $1,073,000. So I think trustees will allow it as long as you've got the right platform, but I think they'd be very, very careful in the.
Mike, it might be a good idea just to explain, if I could just explain, and John, feel free to chip in, the role of the trustees, because...
Sorry, George, I'm going to come on to this. This is really important. So just give me 1 second just to finish our roulette wheel of asset classes. So on, crypto, beware of the bubble, right? CrowdProperty, I'm going to answer that. The answer is yes. We've got bucket loads of pension capital, but it is trustee dependent. Okay, so let's move on to exactly that point. There's a big question around investment control, governance, decision making. Do I need a professional trustee in place? Do we need to align? What if there are differences? Lots of stuff around decision making. So maybe if you could allude a bit on the SIPP and the SAS side of things.
Yeah. If I go first, and John, feel free to chip in. But the role of the trustee is basically to make sure that the pension, sticks to all the pension rules and legislation. Because if the pension money is used for investments that are not qualifying, ultimately you could lose your tax benefits. The whole thing can get shut down, and all these wonderful tax savings, no CGT, no income tax on rent, and so on and so on. That could all be jeopardized. So, the role of a trustee is to make sure that the pension is running in accordance with the pension rules and legislation. And so it can be frustrating sometimes when people say, oh, I want to buy this, I want to do that. And we say, let me run it by the trustees. And we come back and say, sorry, they won't do it. That can be frustrating, but it's there to protect the member of the pension scheme.
For a SAS, you can not have the professional trustee, and you can run the scheme yourself. But I ask the question, why would you? For the sake of 500 quid a year, it's a full-time job running a pension scheme. You've got to do VAT returns. You've got to speak to the pension scheme regulator. There's so many things that you've got to do, and you guys are all business owners anyway. So why do you want to add more time trying to run a pension scheme which you've never run before? So for the sake of 500 quid, I just pay it. But I know there are people out there who want to save on that as much as possible. The thing is, if you get it wrong, you can have an unauthorized payment, which can lead to between 40 and 55% tax charges, and also the SAS trustee gets a 15% charge as well. So for me, for 500 quid, if you're worried about that, why are you even setting up a SAS in the first place? Is my view.
I think that's the wise words. Just briefly on that, my personal experience, so this is definitely unqualified experience, is make sure you're checking which investments the trustee will allow if you have well in advance of moving your funds to them, because then you can get clarity on their sort of investment committee decision making around things you have immediately front of mind. I've faced some irrationality of that, where I was invested in a venture capital fund, and they wouldn't. They're resisting allowing me to resist in the next venture capital fund from the same firm, which is insanity. Anyway, so let's talk about. We're back to the asset class roulette wheel, whiskey.
Yeah.
Tangible, movable. You can use it as security for loans, but you can't buy it directly.
Right, good. Same with you, George?
I didn't hear that, Mike, sorry.
Whiskey, probably same for wine, yeah?
Whiskey, oh my God. Well, the trouble I've always had personally in fine wine and whiskey is I'm always worried I'm going to drink it, and then that's the end of my investment gone, No, I don't think you can, and you can't invest in classic cars either, or boats or anything. This is the SIPPs I'm talking about. Those rules have been tightened up now. It's been quite a number of years, especially the classic car. That was a classic. I remember it in the 80s when I was just starting out. Some older colleagues of mine had started SIPPs, and they were buying old Porsches and things, and with their pension fund, and driving to the south of France in it, on their pension. And I think the taxman said, no, that's just too easy. So,
okay, but that's it's always worth taking advantage of things early on in these as regulations tighten. So Let's talk related to that point. Okay, what's allowed and the tax benefits and all of that. Let's look ahead. Do we think the Chancellor is going to tighten anything over the coming years, given the context of where we're at?
Yeah, I'll give you my view on that, and then John, feel free to chip in. But especially with all the freedoms, the pension freedoms of how you exit from them, and the ability to request a cash transfer value of your defined benefit scheme, I just can't see that changing, because the tax take has shot up. I'm talking about the income tax take. So despite all the fantastic tax advantages, we've got situations where people are over the minimum age of being able to draw pensions, which is 55, and they're drawing out money from their pensions. They're not restricted to levels which they were in the past. So the income tax take has shot up. People can take lump sums out whenever they want to, pay some tax on it, but that's putting more money in the kitty for the Chancellor. So I just can't see them ever going back to how it was before. This is my view.
And go on, John.
I certainly think they're making it more difficult to put money in pensions. I mean, when I first started out, the lifetime allowance is at 2.25 million. That's a million or just over £1 million, and they've just frozen it in the recent budget. So and also the annual allowance has come down as well, how much you can put in every single year. It was 200 grand above before in the earlier days when I first came into the industry. So they're certainly reducing the ability to go into pensions. So yeah, it's difficult, but you can't really call these things. It's difficult.
Okay.
Do you think it's interesting, like sort of conflict there? Because I've often think, well, on the one hand, the government give all these tax incentives to encourage people putting money into these schemes, but then if you could got unlimited money, it's too good, and so they limit you. So it's just finding that right balance. They sort of steer you into that level, don't they?
Yeah. The government have only just sort of brought in auto enrolment. So that, they wouldn't have gone through that massive project to start getting people to save into pensions and then suddenly change it all. People are really being encouraged to save money into pensions. So that like you say, there's conflicting points from both ends. I think they just want people who have got a lot of money to pay tax. I think that's one of the main points.
Yeah. That is only going to get more severe as we move on, and that's effectively the budget. But I think well crafted, personally. I think the point there is very interesting. It's so there's lower thresholds that you can put into a pension. Okay, i.e. you've got more outside that you're paying tax on and potentially spending in the economy. And as George alluded to there, if stuff is allowed to be taken out at an income tax charge, then you've got income tax take there, and you've probably got spend in the economy. So maybe that's the balance here of what will happen over the next sort of few years as we try and drive investment, is cap the amount you can put in, enable a bit more to come out. And that would balance, because they're vast sums, right? It's greater than the GDP of the UK, and our national debt is at GDP levels. Yeah.
It's interesting. Like I said near the start of this session, a lot of people I've met have gone on with their business. They've become experts in their own field. Some done remarkably well in property development, and they just have this money in the background, and it's actually very frustrating for them. What the rules allow here with these two products is they allow people to access this money and actually take some control over how that money's invested. You don't have to have £500,000 stuck in a insurance company fund, just drifting effectively. You can literally have control of it and make use of it. So that's what's really attractive to a lot of people.
I certainly personally believe that I have a different risk and reward profile than a pension fund, and that's how I like to think about, and hence me having a SAS. I'm going to move on. Conscious of time, But let's ask a couple of questions. Oh, wait a minute. We've got the roulette wheel is back. Film production.
Oh God. Well, you can invest in private limited companies. You don't have to invest in shares that are quoted. You know, either sort of even AIM shares can be invested. So in a SIPP and a SAS, you can invest in private limited companies. So if that private limited company invests in a film partnership, it is permissible. But given the what's happened in the recent years, again, trustees will be over that. They want to know. They would do some due diligence as well. So, when I say, it might sound like this is conflicting, because on the one hand, the whole point of a self-invested scheme is you choose the investments, but the trustee also has a sort of a bigger duty to make sure that it's not, basically. So it's interesting. But in theory, yes.
And a trustee may also charge due diligence fees as well.
Yes. I mean, in both cases, John touched on a SAS annual fee being typically 500. I mean, that's very typical for most SIPP trustees. Interestingly, you'd argue that a SIPP should have a lot lower annual fee because they've got a lot less admin to do. They don't have to do annual accounts. I mean, in case it's not come out across today's session, a SIPP is a personal pension. The money is owned by the individual, and a SAS is a company pension. The money is owned by the sponsoring company. So there's a lot less, if you like, administration to do for a SIPP. But the trustees have fees for everything. They've got their regular annual fee, and then most of them produce like a charges booklet, which says if you want to buy a property, it can cost us £100 just to appoint the solicitor if you want to, and the surveyor. And it goes on and on like that. So their argument is they're being paid as and when you use the services. Which is fair.
You mean, George and John, there are hidden fees in financial services products?
No. What do you mean? Everything's completely transparent.
I think my fee pages are 2.5 pages long. And look, this is why this is why you guys can really decode that and demystify these things for everyone as regulated advisors. I'm gonna just a couple of questions about children. One question about a definition of an adult child. Is that 18 years and over?
Yes. Sorry. Yeah, that's right.
Right. And also, can you add children to a SAS after opening one? And if yes, what effect does it have on the division of money in the SAS at that time?
You can be a member of a SAS from the age of 18. But the proportion of the person's benefits within the SAS depends on where that person wants the money to go to. So they'll sign an expression of wishes. So it depends on where they want it to go. So they can divvy it up between the children or one child or other people. So that's at when you set up a SAS, you will complete an expression of wishes, and that will divvy it up between the people that you want it to go to. But you can have a child in a SAS at 18 years old.
Yep. Great. A couple of things about SAS loan backs has caught the imagination. Predominantly around interest rates. Is it a nominal interest rate? Can you set your own? What's the sort of the form there?
The rule is that it needs to be 1% above base of the main high street banks. So what's that? 1.15 at the moment. So very, very, very low.
Yeah.
But most trustees will ask for a reasonable investment, because they'll say, right, yes, we'll loan this money out, but we want a decent return on it, because our job is to make sure that the benefits the members when they retire. So you won't really see a trustee that will do a rate that low. So typically you'll see anywhere between 3 and 10%. But, really that's money that's going back to yourself anyway. So you probably want to get that interest rate fairly high because that's money that you're paying back to yourself.
Yeah.
Yeah. And yeah, I guess with that, you have some level of flexibility there depending on where you want that money to sit. Yeah.
Sorry, in terms of?
Well, if you do a loan back, do you want the effectively a high interest rate to take more money into your SAS, or a low interest rate to keep profitability in your loan back entity?
Yeah, I mean, if cash flows a bit of an issue, you can go down to 3%. But if you're flushed with money, you can bring it up to 10%, and you're increasing the value of your fund. And also that's a way of, if you're doing a 10% loan, that's a way of sort of getting around the how much you can fund a pension, so the 40,000 limit, and that's a way of increasing things, because the interest rate doesn't go towards your annual allowance.
Yeah.
And just talking about the annual allowance, just make it clear for everyone, what is that, and is that any different between Sasses and SIPPs?
It's the same actually, Mike, and it's £40,000 per tax year for each individual, £40,000. When you've actually managed to contribute £40,000, you can then go back 3 previous years. So you can only go back actually if you've got an old pension. If you've never had a pension ever, you can't use the carry forward rule. You're just stuck with 40,000. But in theory, if someone had, say they worked for a company when they were 21 for 6 months and had a pension, with that company all those years ago, never put a penny into pension since, that's it, job done. They're allowed to go back 3 years. So we've had cases like that where we've just literally had 160K go in, which is this year's 40,000, the previous 3 years 40, and all of that again would attract tax relief, whether it's an employer contribution, which gives the tax relief to the company, corporation tax, or whether it's a personal contribution, it's tax efficient.
And sorry, George, just in regards to this as well, I mean, I'm getting someone to literally set up an AJ Bell SIPP just because they've never had a pension before in the past. I'm getting them set it up just before the 6th of April, so that they've owned a pension contract in 2020-21, so that they can benefit from that 40,000, because they're not going to get SAS set up in time before the 6th of April, because it will take 3 or 4 months. But I've told them to go off, put a couple of £100 into an AJ Bell SIPP, get that pension contract, and you get to benefit from last year's that carry forward as well. So that's
good advice. And don't forget also that the only allowance is per individual. So where a SAS has been set up, if you've got say 3 individuals, that's effectively 120,000 in a year from each person. So the SAS could receive 120, or 4 lots of 160 if they tick all the boxes. So like I said, don't forget the SAS is more of a combined scheme. It's a company-owned scheme, and it's money going in is based on the annual allowance per individual. The SIPP is just individual.
I have a suspicion that for some property people, that's going to be interesting, especially that count back tip, because it's not like all of us here are selling widgets. We're selling big lumpy things when we do, and that might be accentuated, or spikes of money coming in that you can allocate out tax efficiently. So I think that's a great tip.
Yeah.
Best time to do that, Mike, as well, is just a couple of months before company year end as well. So depending on what projects you've done. But in the SAS example that I showed there, the 3 directors, they can put up to 480 grand in one go. So you put that as a pension contribution in, you're saving 90 grand in corporation tax, but you put that money in day 1, day 2, you can borrow it straight back out with the 50% rule.
Yeah. Very good.
One last footnote on that, Mike. So one last footnote on that, and that is that money can transfer from pension to pension, no problem. These rules only apply for money being paid in.
Yeah. Yeah. And again, it's watch for fees, isn't it?
Yeah.
So. Yeah. Very good. I'm going to fire one or two just very brief questions. We are overrunning, and then we'll wrap up. We might stick around a bit afterwards. Define trading business. So we touched on this earlier. No shells allowed, but what about a limited company that holds a buy-to-let? So someone has incorporated their portfolio or something. That presumably is a permissible business to have a SAS pension scheme associated.
It's generating an income, and it's probably paying out costs. So it's a trading company, so that's fine.
And but obviously then. Loan back to buy resi property is not allowed. But I think it's really important for people to understand. Right? Okay. There's the limited company that the SAS can be associated with, and then there's what's companies that so those SAS funds can be used towards. So there are different definitions there.
The loan back. The advantage of a SAS over a SIPP in this scenario is that the loan back can be used for residential property if they need to. It wouldn't be fair to sort of be able to give loan backs to all other companies apart from properties that deal with residential property. I think we'll the revenue will be keeping an eye on that over time to see how much people are actually putting SAS money into residential property developments, but at the moment, you can actually do that, so that's fine.
Yeah. Good. Okay. Right, guys, we're going to wrap up this formal bit of the webinar. So, on and let's, if people want to keep asking some questions, we can continue for a little bit. Fortunately, both John and George can stick around briefly. And just really to wrap up and say, hey, look, get in touch with George and John. Having that regulated advisor is valuable and important. You've already heard loads of tips as well as the depth of insight here. So there are rates available to Qandor Tropolis members. And look, this was brought to you with by Qandor and Tropolis, and a bit like Have I Got News for You, a guest host coming in, and we've had all sorts. We've had Have I Got News for You? We've had Chris Whitty, and we've had some brilliant tips. So hopefully you've got a load of value out of that. Look. Don't forget about your pension pot. Keep it working, get it working, and put more in because that's very tax efficient if that's appropriate to your circumstances, which George and John can advise on. So formally, before we continue informally, thank you very much, both of you. Any parting words from either of you?
No, I just hope that it was informative for everybody, and they got what they bargained for.
Yeah, I mean, just the SAS world is unregulated, and you've got lots of people sort of coming up with lots of different ideas. Just seek advice from the trustees and advisors first before you go off and do something, and then you should be able to stay within the rules. A bit of a negative ending, but that's my sign off.
But incredibly important, right? Because the HMRC penalties wipe it all out. And that it's vitally important that you're within those. So tread carefully, but there's lots of opportunity. So formally, thank you, much appreciated. Thank you to everyone who attended. I'm going to fly through a few other questions informally. So if you can stick around. If not, thank you very much for attending, and see you hopefully at a Qandor or Tropolis physical event soon. Looking forward to that. Brilliant. Right. Okay, let's dive into a few more quick fire. Right, I haven't read these yet, so I'm just going to pick them out. Now we're on the sort of informal chat bit. Can we use an LLP for a SAS instead of a limited company?
You can use an LLP, but you can only use it to purchase commercial premises. It doesn't allow you to do the loan back, which is kind of the whole point in the SAS, really. So if you're going to use a pension with an LLP, it's typically a SIPP structure. I mean, you can use a SAS as well, but you don't get the full benefit if you're using a SAS.
Right. Okay, good, thank you. If you have multiple SAS members, which is possible, as you said, up to 11, I think, are the funds split as per their payments? And if items are, then how are profits split?
So this is going back to the point about having a professional trustee. Imagine you've got 7 people in the SAS doing contributions, past pension transfers, growth, and then monitoring that, because that's their job. That's their job, to work out what the split is. So contributions and transfers, that person will have a certain percentage of the SAS, and that's monitored by the trustee.
Yeah.
Right, that's right. And I would just chip in with that and say that every member of a SAS, their entitlement is based on how much they put in. So often these things start with 2 or 3 people that have got existing pensions, and they move it in to start it off, but they've got different amounts. So it's like having a stake in the SAS. Imagine the SAS as a big entity and you've got a stake in it. So the more you put in as a member, the more you're entitled to take out. Yeah, and the trustee controls that, as John has just said.
Yeah, right. Now we've got some interest flooding in about loan backs. I think people are getting excited about this. Property entrepreneur minds whirring, shall we say? So loan backs, is it limited to a percentage of the SAS? And is that affected by anything like your sort of roll up from previous years? Is it related to the pot? Is it 100%?
Loan backs are limited to 50%, but you can have multiple loan backs. So you could do a loan back in 1 year. You could pay off a couple of years' payments, and then that will mean that the SAS value has increased, and therefore you've brought the loan level down to about 45% or 40%. As long as you don't break the 50% limit, you can have multiple loan backs, but 50% is the limit.
So 50% of your pot outstanding at any point?
Yeah, the 50% of the net value. So you might even have mortgage borrowing in there. So if you've got mortgage borrowing in there, there'll be, you'll have less loan back. But just think 50% is the figure, really.
Yeah, great, thank you. And purchasing of property, so commercial property. So you mentioned you can borrow 50% again. So if you've got a 1 million SAS pot, I think you said that we can then, and SIP, we can then buy a 1.5 million commercial property, and that's the 500k, i.e. 33% of the overall value, would come from presumably a mortgage provider.
Yeah. That's there are commercial loans, commercial lenders, basically. So in some cases, the same commercial lenders that would lend if you were buying the property in your own name or a company name, they would lend through the pension. So their customer would be the pension, would be the SIPP or the SAS, effectively. But again, the loan is secured by first charge on the property. It's interesting. Did you notice that if you're limited to only borrowing 50% of the pension value, using that example, Mike, if a property costs 1.5 million and the pension's worth $1 million, you can borrow 500, of course, and the $1 million goes down as a deposit. That's only 33% loan to value, isn't it? It's only and again, there's been some misunderstanding over that with clients that you say to me, that's a bit mean, but the banks can lend 50-60%, can't they? And we say, look, it's not the banks. The banks would happily lend more against that property. It's just the loan is limited by the pension rules. So the pension rules are 50% of the pension value is what is the most you can borrow. Yeah, it's not the banks.
That's built in to protect the pension value, basically. So if you do lose the asset, you haven't lost all of your pension. So that's why they build that in.
Yeah.
And just to understand that, so what if you had £1 million pension pot?
Yeah.
And you were buying £1 million property?
Yeah.
Okay. Is the leverage on that £1 million is still, it's not 500k, i.e. 50% of the pot. It's effectively 33% of the purchase price, right?
Yeah. If you're buying for 1.5 million and you've got £1 million in the pension, the £1 million in the pension will be used as the to go towards it. That's 2/3, and the 500,000 would be the loan, which is the remaining third. Yeah.
Yes, but what I'm just saying is that if you got £1 million and you were buying £1 million property, you can't still get a 500k pension because it's 50%. It's the amount versus the amount you're buying it for, effectively.
At the moment, I've got a client who's got a pub in his SAS, and he's coming up to 55, but he hasn't got liquidity in there. He's just got the pub. So the pub's giving him 60, 70 grand a year, but he needs tax-free cash. So we're raising another 500 grand on top of the pub to create liquidity in the SAS so that he can get hold of some tax-free cash. So, there's lots of reasons to use that, not just to purchase, at outset. We're using it to create some liquidity. And we're also lending some of that money created in the SAS to do a loan back to his solicitor firm as well. So that's a fairly interesting piece of planning.
Good. Just to go back to your question, Mike, or your example, if you've got £1 million in the pension and you're buying a property for £1 million, you can still borrow up to 500. You can still borrow half the pension value. So if you wanted to say, look, I'll go and buy that property for £1 million, I'll take a 50% loan, effectively, you've still got another 500,000 in the available for other investments, haven't you?
Ooh, okay. Well, this is interesting. This is slightly different. Okay. So what if I'm buying it 700k? Can I still get 500k and put it against it?
You can borrow 500,000 as far as the pension's concerned.
Yeah.
Then you might breach the lender's loan to value limits. Yeah. So you can't ever breach the lender's loan to value limits.
Sure. So typically, say it's a 70% LTV on a generous commercial, and you're buying at 700k, then theoretically I could borrow 490. That's under 50% of my $1 million pot, and actually I'm then getting to 70% loan to value. Is that correct?
Well, so from the pension point of view, the 490,000 loan, as long as it doesn't go above half the value of the pension at the time, which it would be fine, wouldn't it? And then, as long as the lender is prepared to lend the 480, 490 at 70%, then it's fine. Everyone's happy, yeah.
Right. Good. Now that's better. We're property people like leverage. Okay. Good. Thank you. Question for you: what happens when the value in the pension pot exceeds 1.073 million?
Classic question. Should we both have a go at this one? I mean, this is the famous old lifetime allowance, and as John has said, it actually has been going down gradually over the years. I mean, at one point it was 2.5. Was it over 3 at one point? If my memory serves me right.
2.5.
Yeah, I remember it when there was no lifetime allowance. It was absolutely brilliant. But anyway, that's showing my age. So, okay, very quickly, when you come to draw money out of your pension, the current level is £1,073,100. Okay, it's a strange figure. That's because it was £1 million for a year or two. They decided to increase it, index link it. So we've ended up with this odd figure, 1,073,100. Right. So if you are drawing money and your pension's worth less than that, it's no problem. If it's worth above that, it depends how you take that amount that's above the limit, when you take it as income or you take it as a lump sum. If you take it as income, you get taxed 25%. It's like a surcharge. Don't forget, only on the bit that's over. If you take it as a lump sum, it's 55%. So it's quite steep. Yeah. So just give you a very quick example. If someone's pension was worth £1,473,100 by coincidence, i.e. £400,000 over the limit, if they said, I want to take that 400,000 out as a lump sum, taxman would want 55% of 400 in that example. So you probably wouldn't do it. But like I said, it's a bit of a conflict. We've got incentives to build the pension pot up. We've got to keep an eye on that limit as well, you know, depending on what we're doing.
One of the bits of planning that I was doing was if people are approaching the lifetime allowance, is potentially moving their pension to a QROPS. So I don't know if you guys have heard of that. It's a qualifying registered overseas pension scheme. Now, these rules might change after Brexit, but that was a way of getting the money out before the lifetime allowance charge. Once it's in the QROPS, there's no other test against the lifetime allowance, so you could grow it up to 10 million and there wouldn't be a charge. But the only thing about QROPS is the market is very, very small, and you have to end up with pension trustees, you know, being out in Malta and various places. Although it's, you know, it's a sophisticated finance arena, it's kind of on the sort of it's a smaller niche market, and it's always being looked at. But that is one way that you can mitigate the lifetime allowance.
And just on that lifetime allowance, is that based on the amounts you put in, or if you have asset growth within it and that takes you past?
Both. So it's at the point of extraction. So whenever you come to take benefits, it's what that asset has grown to, you know, plus the contribution. Very
Was that a Labour government bringing it down?
Wouldn't be surprised.
Very good. Let's not get political at 26 minutes past 3. It's can of worms. Right. Okay. Thank you very much. I think we are. Quick one. Commercial lenders that will do this. I mean, regular high street guys offering commercial product, or is it quite specialist?
Both. I mean, we've done them through Barclays. They're okay with it, and you've got, you know, other lenders that are a little bit more specialist in the background. Like I said, most lenders that you know, Qandor and Tropolis members will know and love will probably actually lend to the pension scheme, because they take a first charge on the property, and you know, most of them understand it. Yeah, most understand it.
Yeah.
It's a smaller market. So if you're doing it for a Stas, it's a smaller market. Therefore, there's less providers out there, and you know these guys are sort of used to dealing with, you know, 1, 2, 3 million, you know, excess funds of that sort of amount. Whereas with a pension, because you've got the lifetime allowance, there's not really much lending you can do there. So the appetite isn't necessarily there for it. You can find lenders that will do it, but it will be a higher interest rate than normal, and there's not a huge amount of providers out there. Yeah. So in theory, you can do it, but it's finding the lenders that are happy to. Typically, it's done on if you can find a commercial premises that's producing a decent yield. That's what they're happy with.
Mm-hmm.
Brilliant. Finally, on the magic 1.073 number, you mentioned there's an income tax implication on that if you draw it, but is there an inheritance tax and/or capital gains tax implication as well?
No. So, like I mentioned earlier, if somebody dies, do you know what? We're not going to have time to go through it fully, because there is this like magic age, which is 75. If somebody dies before age 75, then the entire value of the pension, regardless of the value, you know, 2, 3, 4 million, can transfer to beneficiaries without inheritance tax. Okay. If someone dies over 75, it's more complicated, and so we wouldn't want to get into it right now. But there's no CGT, so this tax charge on withdrawing from pensions that are over the lifetime allowance is a one-off charge for that purpose. It's not classed as a income tax charge or a CGT charge. It's just a a lifetime allowance tax charge. I think they call it an excess charge sometimes, but the rates are 25% for income above the allowance, 55% for lump sums taken out above the allowance.
But you've obviously had the benefit of it going in tax-free, accumulating tax-free, and so it's on the way out that that charge comes in.
You get tax relief. So £60,000 gets you £40,000 of tax relief, roughly, if you're a higher rate taxpayer. So you've benefited from more money going in.
Yeah. Definitely, it definitely works out. I mean, I can't remember the figures, but I did for one client. We sat down. Went back like 15 years, say, look, when we set this up, in 2005, do you remember? Look, this is how much you put in, this is how much tax you saved. Then we worked out all the rent that had been received in 15 years, tax-free. Look at the tax you saved on all that rental.
Exactly.
Then the CGT that you saved, look how much, and we actually did a sum. He was well happy. About this charge. Once we sort of put it into perspective and did the sums, he was well ahead.
We all know that property people don't really like pension, but the fact is that because you can do these things with pensions, they shouldn't sort of discount them, really. That's one of the sort of big things. You tell me a property person that's got loads in pensions, that's normally a surprising conversation when I speak to them about that.
And surely if Einstein said that compound interest is the 8th wonder of the world, he would say that tax-free contributions was the 9th.
Exactly.
And so I'm going to wrap it up there. Thank you once again for extending the time, John and George. Really appreciated, valuable input, very much shown by the many people who have stuck around for a bit of extra time. So thank you very much. Enjoy your day. I'm sure you'll get a bombardment of further questions because this is a complex topic and there's lots of personal situations to consider, and that regulated advisory point is just so crucial in that. So hope the audience gained great insight, and on behalf of them, thank you very much.
So if you enjoyed this video, why not check out some of our other videos? I recently interviewed lots of fantastic people. There's loads of good content in there. Thanks for watching. I hope you enjoyed it. I'll see you in the next video.